So let's get started talking about Bollinger Bands, one of the world's most renowned technical indicators. Now, in tonight's class, I'm going to use the term security, but I might say Facebook or the Euro or Google. I might say Bitcoin, but I'm not referring to any specific investment vehicle. When I mention these, I'm just making it so it's not boring just saying security, security, security. But tonight we're talking about all publicly traded financial instruments in which an open market exists. In other words, any assets you can trade on the ETX platform. Similarly, I intermix the terms investing and trading. Now, since we're all part of the ETX family, we are traders. But I also mix up the terms because it gets very boring saying trading, 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 trading. And so when I say investing, I'm talking about trading CFDs. Now, Bollinger Bands were created by John Bollinger, hence the name Bollinger Bands. And it is one of the most popular indicators for traders, whether you're trading Bitcoin, whether you're trading the Euro, whether you're trading oil or gold. It's adaptable and usable for all markets, and it's one of the few indicators that works extremely well in short-term markets. Now, the nice thing about Bollinger Bands is John Bollinger is still an active money manager and researcher, and he operates the Bollinger Band website. So instead of going on the internet and going through and learning from all these kind of gurus out there preaching their own little thing, you can actually go to Bollinger Band's website and learn from the creator. Now, there is an abundance of information published on how to trade with Bollinger Bands. Much of it, though, is discretionary in theory. In other words, they all use Bollinger Bands, but they'll all give you their own personal interpretation of how to use them, or they'll give you their own strategy, their own method. The how to use Bollinger Bands information usually pushes it back to the trader to interpret what the security is doing relevant to the bands. Now, let me take you over to a chart, and we're going to just first see about what Bollinger Bands look like and how to actually easily drop them on your charts. Now, as I mentioned, Bollinger Bands can be applied in all financial markets, including equities, Forex, commodities, and futures. Bollinger Bands can be used in most time frames, from very short-term periods to hourly, weekly, and monthly. So let's just take a look at these funny little things and put them on a chart for you. Now, I'm using my standard teaching charts, which are from TradingView, but you should be doing this on the ETX Trader Pro charts. And you should be always trading from the charts on Trader Pro. And shortly, we're going to watch a presentation of how to put these on to Trader Pro. Okay, now, Bollinger Bands is such a popular indicator. Wherever you're using them, just locate the indicator selector and drop them onto your charts. So we're going to go up here and we're going to drop Bollinger Bands on our charts. There we go. We have our Bollinger Band automatically put on our chart. Okay, now we're not going to talk about what all these lines mean yet. We're going to get to that in a minute. But this is what Bollinger Bands looks like. It's a squiggly little envelope that surrounds price, but the envelope shape, sometimes it'll look like an alien, sometimes it looks like a worm, sometimes it looks like a mountain range. The actual shape that you're seeing doesn't tell you anything about the markets. You don't interpret it because you see a dragon or you see a snake. Now, the width of the bands tells you how volatile the market is. The more contracted the bands are, the more contracted the market is. The wider they are, the more volatile the market is. And these are called bands or envelopes. In this case, we call them Bollinger Bands, but they can be referred to as envelopes because they surround price. Now, let me just get back to my PowerPoint here. So Bollinger Bands answers a very important question. Are prices high or low on a relative basis? By definition, prices are high at the upper band and prices is low at the lower band. So what it's saying is in the movement of the asset, prices when they're reaching that upper band tend to be trading towards their high price. And when they're down towards the bottom band, they're trading towards their lower price of the most recent levels. Now, this is a bit of information is incredibly valuable. It is even more powerful if combined with other tools, such as other indicators for confirmation. Now, Bollinger Bands are a technical analysis tool. Specifically, they are a type of trading band or envelope. Trading bands and envelopes serve the same purpose. They provide relative definition of high and low that can be used to create a rigorous trading approach in pattern recognition and for so much more. Bands are usually thought of in employing a measure of central tenacity as a base, such as a moving average, whereas an envelope encompasses a price structure without a clearly defined central focus. So Bollinger Bands, because they're a band, uses a central point. And for Bollinger Bands, that is a 20-period moving average. So Bollinger Bands uses a 20-period moving average and then something called a standard deviation. A standard deviation is a statistical or mathematical calculation that's quite complex. So let's go back over to the chart. Now, you'll never have to calculate this. And as you saw in the charts, it's automatically dropped on there, but you have to understand where these come from. So we start out Bollinger Bands with a 20-period using the close moving average. And this is the brown line you see going over price right now. Okay, I've prepared and set it up ahead of time. So that's just simply a moving average of the current price. Whether you're using a 15-minute chart, a 1-hour chart, a 1-day chart. For class, we're using a 30-minute chart. Then we do these calculations that are called standard deviation. And Bollinger Bands uses a 2 times standard deviation to give us a line above and a -2 standard deviation to give us a line below price. So the top band is a 2 standard deviation above the moving average because it's calculated based on the moving average, and a 2-period below the moving average. And hence we have the upper and the lower bands. Those are the green lines I put on your chart. Now we've colored in or highlighted the band itself with a pale yellow, and you can use whatever colors you want. This is not the standard color. I use these because they're easy for you to see in class, these color combinations. You could use pink, purple, and red if that's your favorite colors. Doesn't make a difference. So what we have now are our upper or lower band and our moving average band. That moving average band is quite important. And this calculation for this upper line is based on this moving average, and also for this lower line is based on this moving average. As I said, this is 2 standard deviations above and the 2 standard deviations below. So let's talk about what this thing is that we call standard deviation, because you don't have to calculate, but you have to kind of understand what it is, because the only way you're ever going to notice if there's false signals or problems with the market. Hold on, let me get my slide up here for you. There we go. Is now interesting, in the real world, no statistician would ever calculate standard deviation by hand. The calculations involved are somewhat complex. Now, by default, the standard deviations for Bollinger Bands is 2 standard deviations. Now, this is going to be a lot of mathematical talk, okay? But we'll get through it. You don't have to memorize. You don't have to understand it, okay? Standard deviation is a measure of the dispersion of a set of data from its mean. Another word for a mean is moving average. It is calculated as the square root of the variance by determining the variation between each data point or each price close relative to the moving average. If the data points or the price close are further from the mean from the moving average, there is a higher deviation within that price data. So in the simplest form, the mean is simply the average of all the data points in the given set. In investing, for example, you might want to know the mean closing price for the last 20 days or the 20-day simple moving average. So this can be obtained by adding the closing prices for each session and dividing by 20. So if we're using a 30-minute chart, we would go back to the close of each of those 30 minutes or each of those candles on a chart, add them together and divide by 20. Because the markets are fickle at best, traders and analysts use moving average to adjust daily or by our time frame to incorporate the most updated data. This means the calculation always takes into account the most recent session's movements, and older sessions drop off as they become less relevant. Now, if you don't understand moving averages, then you need to come to our class on moving averages and understand what they are. Now, an exponential moving average is calculated by weighing each data point, giving greater significance to more recent data. Standard deviation is calculated based on the mean. The distance of each data point from the mean is squared, summed, and averaged to find its variance. Now that's a lot of math. Or to put it another way, variance is derived by taking the mean of the data points, subtracting the mean of each data point individually, squaring each of these results, and then taking another mean of those squared. Wow, that's still a lot of math. So standard deviation is simply the square root of the variance between the current closes and the moving average. So let's go back to the chart. So all we know is this number here that was calculated to give us the upper band. Is 2 standard deviations above this moving average or 2 standard deviations below. That's it. Now the above and below calculations are exactly the same, just one above, one below. The distance of this band can be plotted on a chart below also to give you the width of the bands. So this is just called Bollinger Band width, because if they get very wide very quickly, that's telling you the market's got a lot of volatile. If the bandwidth is still staying relatively steady, that's telling the markets are constrained. I don't use Bollinger Band width simply because I can look at it and see. A lot of people like to use a chart with Bollinger Band width as a separate calculation. And you can go to the indicators. Oh, there we go. And you can just click on Bollinger Band width and drop that on your calculator down below. And we can see, and this is simply the width of the band. Now, once we've got, and as you can see, this was very simple to put on our charts. There's nothing you have to do. There's no special remedy. Now, as today with most of our charts, we have the ability to customize these indicators. I rarely ever do. Okay. The reason being is I read the strategies, or I read the development, or whoever's developed the the band, and they've tested it for years, and they've tested it using their formula. If I customize the formula, it's no longer going to give me the same results that I'm reading about. Now, there are some interesting ways we can use what we call an offset, because as you know, moving average is a lagging indicator and it leads behind. We can use a 3-period offset and help move this moving average a little bit forward to make the lag a little bit less. But again, the minute you do that, and something I do like to use, then you can no longer swear by all the rules you get because it throws the rules off. But once you've made that adjustment, you've tested it long enough and you see the variation. And the best way you can do this is by dropping 2 Bollinger Bands over top of each other and seeing what the difference is once you've customized the indicator slightly. As a lot of people also will come here and use a 2.5 standard deviation. Actually, a 2.5 standard deviation, because what that does, it changes the upper and the lower band. But by doing so, you'll get less false signals because it'll have less sensitivity. So again, you can customize it, but then it's no longer following the rules of John Bollinger. Now we have these funny little things on our charts. What can we do with them, or what are we going to start looking for when we have them on our charts? So first, let me show you how. Hold on, let me go back to my PowerPoint. And then I'm going to show you how you would put these on the ETX platform, how you would use the charts there and put your technical indicators on. So remember, we're using a base of a 20-period moving average. We're using an upper band, using a default setting of 2 standard deviations, and the lower band using the exact same, which will be technically a negative. So let me share with you a little presentation on how you would use the Trader Pro technical indicators to put them on your. Now, once you've got your Bollinger Bands on your charts, you need to be able to read them. Now, Bollinger Bands has 3 primary uses. Number 1, it's pattern recognition. Number 2 is reversal signals. And 3 is trend analysis. So the simplest of the use of these is what we call the Bollinger Bands patterns. They're very simplistic, but fairly reliable, and they take a long while to develop. So it's not something you have to see right away. It's not something you have to start planning for right away. It's not something with a blink of an eye it's going to be over and done with. There are 2 primary patterns we wish to consider trading that we see develop in the Bollinger Band. And this is called a W and an M formation. A W can be defined as a double bottom pattern. Now what's going to happen is a W pattern only forms when its price is coming off of a downtrend. And it's going to form the first leg and it's going to hit a bottom. Okay. Wherever that swing low is, wherever the close of the lowest closes gives you that bottom. Price will then bounce off of that bottom, but not return to as high as it was. And will bounce up and come back down and form another bottom equidistant to the previous bottom. This is what we call the N formation. Because in order to form the W or the M, it has to form an N. Because until you've got the 3 legs started, the rest of it's never going to happen. So you don't even have to notice it until it's finished its 3rd leg and moving into the 4th leg. And in fact, even if you haven't noticed it, the only time it actually becomes vital is when it starts to break the moving average. So you can not even notice it till here because you can't trade it. It doesn't tell you anything until it breaks the moving average on the 4th leg. In other words, if you know what a head and shoulders pattern is, until that head and shoulders pattern makes the right shoulder and breaks the neckline, doesn't tell you anything until those two events happen. Whatever preceded it is relatively unimportant. Now, when it breaks the moving average, so it forms the first leg, third leg, comes back up, bounces off that bottom. Until it breaks that moving average, it's not telling you anything. When it breaks that moving average, it tells you the previous trend is over, and it should have the momentum to carry it equal to the beginning of the first leg formation. That means you can set a target price here, find a buy opportunity here, and set your stop loss here. Now, this is coming off, as I said, off of a downtrend, and we have the exact opposite coming off of an uptrend. Okay. Price moving up, hitting a top, coming back down, forming the base or the third part of the N, bouncing back up, and it forms the full N formation. Leg, 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 bounces off, comes back down. When it breaks that moving average, wherever that moving average is, you now have, in this case, a sell opportunity, target point, stop loss point. So the W and N, the bearish top patterns formed by two successive tops in price, which is the opposite W from the M. Before forming the entire M, an N will emerge in the price action, and this is the point at which traders should want to get involved and see what's going on. Now, we highly recommend combining Bollinger Bands with the RSI indicator because it's a perfect match. Because just trading off of that W or that M formation isn't going to give you any guarantee. Well, nothing gives you a guarantee, but you need something to confirm. So the RSI indicator is a very good indicator to work with Bollinger Bands. Now, also, we do see in regular trading top formations. Okay, and these top formations or bottom formations in a downtrend also help give us some pertinent information. Combined with the RSI going to overbought or oversold and a divergence in RSI, we could have a very important clue to what's happening. Now, during trends, the moving average holds very accurately, and a break of that moving average is usually a meaningful signal that the sentiment in the market is shifted. Furthermore, the moving average can be used as a trade exit signal where a trader does not close existing positions unless price has broken the moving average. So as we can see here on the screenshot, okay, so let me get my marker on here. Okay, we see price riding down the bands. Let me get a color we can see. So we see price riding down the bands. It moves back up. If we had been in a sell position, we would not have jumped out here. But the minute it breaks that moving average, we would want to get out. If we were looking for a market entry, as price came off of that, what we call riding the bands down, when it broke the moving average moving up, we would want to consider a long position. So either if we were in the market, that would generate our sell. Even though moving at Bollinger Bands moved up and down, as long as it stayed below the moving average, we wouldn't be selling or closing our current position if we were in a sell position. We would not consider a buy position until it broke above the moving average. But that's only the beginning step. Because now we see it above the moving average and it starts to ride the band. This is when we see a significant move. This is riding the band. Price stays right on that band. But even if price falls off the band, unless it breaks the moving average, we don't have to worry. And it goes back because it's just part of a trend. This is where we would start to worry. When the price moves up to the band, it has nothing to do with the red candle. Price moves up to that upper band, but then gets rejected and comes down and is not able to make that upper band again. And then once again, price is rejected. It cannot reach that upper band. And then price starts falling below. But again, we don't panic until here. But when we see the rejection of the band and then the break of the moving average, that's telling us the trend is over. See the moving average, and we can go into a sell position and have ridden this all the way down as price stayed below that moving average, all the way down in place, rode that lower band all the way down. So while Bollinger Bands are exceptionally helpful in determining when an asset is overshot to the upside or the downside, it's important to use the bands to also set risk conditions, not just entry points. Additionally, risk and reward should be set based on the width of the bands or volatility, with narrower risk rewards during low volatility and wider risk rewards during high volatility. So in other words, in this case, even though we saw the price moving up and the price moving down, okay, with very strong uptrends and downtrends, we didn't really see a huge variations in the width of the band, which is very good. When we see the band get very wide, that's telling us the volatility in the markets is getting much higher. So if we were to enter somewhere at this point where the market is, the bands have widened, we might want to set our stop loss a little bit lower than what we would have when it was in a narrower band. But see here, we have a steep downhill, but look at the width of the bands. They stayed pretty steady that whole width. So we can use that to determine our risk reward factors in setting using our Bollinger Bands. So in contrast to most other indicators, the Bollinger Bands are non-static indicators, and they change their shape based on recent price action and accurately measure both momentum and volatility. Thus, we can use Bollinger Bands to analyze the strength of trends and get a lot of important information this way. So these are the few things we want to pay attention to when using Bollinger Bands. During strong trends, price stays close to the outer band. So during an uptrend, price should stay close to that upper band. During a downtrend, it should stay close to the lower band. If price pulls away from the outer band as the trend continues, it shows fading momentum. So in other words, if we see price moving upward and it's been in that band, staying right on the edge of the band, and all of a sudden it's here while the band is up here, it's telling us that we have fading momentum in the price. Then also repeated pushes into the outer band that don't actually reach the band show a lack of power or a lack of conviction. A break of the moving average is often the signal, the final signal that the trend is ending. So here we can see an entire story of Bollinger Bands. But the fact is, no matter what we tell you in the story, no matter what I make up and no matter what scenarios I tell you, fact is you can only trade from this point forward. So you have to be ready and know what to expect. If you saw the bands riding down here and they started moving back up to that moving average, you can't predict what's going to happen. But when it does, you need to be ready to act. Because like I said, going back and interpreting these stories back here are fine, but that does not help your trading because you got to trade at the wall. So let's walk through the stories that we're seeing. We have step 1, 2, 3, 4, and 5. Now think of them in your head. What are you seeing in 1? What happens at 2? What goes on at 3? What happens here through 3? What happens at 4? And what goes on at 5? Imagine these. can you start telling yourself a story about price and the Bollinger Bands? Well, let's see if you got it right. So in one, price is in a strong downtrend. Price stays close to the outer band all the time, which is a very bearish signal. Okay. See how it's riding down? It broke the moving average up here, and it started riding those bands down, and that was a very bearish signal. Now what happens here? We see it move away from the band. What does that tell you? That this current trend is losing its momentum. Not that it's lost it, it's starting to lose it. Then we get rejections of the outer band. Okay. That's telling us this trend is in trouble. Here we see it break above the moving average. So that trend is now officially over. Here we get what? So in 3, we get 3 swing highs with lower highs. The first swing high reached the outer band, whereas followed by 2 failed, fading strength. Okay. So what's happened is each one of these, so we see here, price rose up and hit the outer band, fell off of that outer band, got rejected the moving average, moved back up and was unable to come anywhere near that upper band. It was rejected. Broke that moving average but didn't stay below it and came back up. Now it's rejected a third time. When it moves through this moving average, we know that this uptrend is now officially over, and we could look for a sell position. And here we see it riding the bands all the way down. And what happens here? It loses those bands. It's losing its momentum. Okay. Never gets rejected by the outer band because it never gets there. It lost its momentum and faded and went straight above the moving average. Moved straight up, but it didn't do anything significant. It virtually reached that outer band one time and then fell off of it. So we never actually had a trend. We had a lot of bad information. But then it broke the moving average again and started riding those bands, but still did nothing. So nothing here or here gave us any tradable movement. So remember, day trading or CFD trading is mostly a game of pennies or small percent or small dollars. The best firms and individual traders who day trade look to scalp for small amounts. Using Bollinger Bands and the percent D or the bandwidth shows that intraday edges do exist. Successful day trading is mostly a game of pennies. Now there is a preciseness here using Bollinger Bands in this way. Using this preciseness to your advantage will give you a lot of advantages. Now, there is a very well-known strategy, and I've given you a handout. If you look on your screen, it says the ETS Capital Technical Indicators Guide. Please click on the download button and download it now. It's a free guide for you. There's nothing you have to do, and it will go over Bollinger Bands and the 5 most popular technical indicators. Now, the Bollinger Band squeeze is more or less a common sense trading mechanism. Okay. It's been around a long time. A lot of people like it because it's a relatively easy strategy. What you're looking for is the bands to contract. When you're looking for the bands to get very narrow, because what do you know what happens when the bands get very narrow? The market is very contracted. It's almost like if you're trading a triangle, you're looking for the price to get into that apex because you know it's going to break out. Well, when the markets get very contracted, you know price is going to break out of that band. Now, none of it gives you any directional signal. Let's go over and see what we have on my charts here. Now, here we don't see any contraction in the bands at all. In a longer period, maybe we can see some. Okay, again, here we don't see much because the markets have been the volatility has remained pretty steady. But when you see the bands contracting, getting narrow, we know sooner or later price is going to break out upward or downward. And this is the Bollinger Band squeeze. When you see price pushed into a tiny little lane, you know it's got to break out. So in other words, it's squeezed in between those Bollinger Bands. Just trying to get my PowerPoint back up here. So you want to keep your eyes on the bandwidth. Now, one of the reasons you might want to use the bandwidth indicator at the bottom of your charts, that's going to tell you when the bands are very contracted. Because when you see it like here, we see it reading steadily at 2.5. That's a very, very narrow band. That's equal to right here. We know at some point it's got to break out of that band. We don't know whether it's going to break out upward or downward, but we know it's going to break out and those bands are going to start to get wider. So even though the Bollinger squeeze is straightforward, charters should at least combine the strategy with basic chart analysis to confirm signals. For example, a break above resistance can be used to confirm a break above the upper band. Similarly, a break below support can be used to confirm a break below. So in other words, when you get the breakout of the band, okay, that's going to be giving you the first bit of direction. If you had your support and resistance lines on your chart, you would want to wait till it broke through, if it's breaking upward, through its resistance band, it's breaking downward through its support band to get the actual confirmation and a trading point. Now, because the Bollinger Band squeeze does not provide any directional clues, chartists must use other aspects of technical analysis to anticipate and confirm the directional break. In addition, a basic chart analyst, chartists can also apply complementary indicators to look for a sign of buying or selling pressure. In other words, we can look for a jump in momentum or a jump in volume. Momentum oscillators and moving average are of little value during a consolidation period because these indicators simply flatten along with price action. So in other words, RSI, stochastics, MACD should all be basically a neutral because they wouldn't be in overbought or oversold conditions because the market's been flattened sideways. So in other words, here we look for a very narrowing band and then we're looking for the breakout. So as you can see, the Bollinger Bands are a multifaceted trading indicator that can provide you with lots of information about trend, buy and sell balances, and about potential trend shifts. Together with the moving average and the RSI, Bollinger Bands make for a great foundation for a trading strategy. So I'd like to thank you for joining us tonight. And remember, ETX is a regulated provider, and we have, I don't know what I'm teaching on Thursday. You can find it on the ETX Trader Pro platform under education, but I will see you on Thursday. So thank you very much for joining us tonight. I hope you learned a little bit about Bollinger Bands. Go practice them on the ETX Trader Pro platform charts. And if you want, go to www.bollingerbands.com and read directly from John Bollinger all about his bands. Thank you very much and have a great trading week. Bye now.